Let's bring in Tony Pasquariello. He is head of hedge fund coverage at Goldman Sachs. Got a real good eye on what the biggest money is thinking and doing. Welcome back.
Thank you, Scott.
So you've been pretty much urging investors to remain fairly positive, if not bullish.
Affirmative.
Okay. Month coming to an end. Now what?
Well, we should call it what it is, which is a pretty tricky week that closes out an otherwise totally respectable month. And so I don't want to dismiss this week because it's been messy and really messy in specific parts of the market.
Right.
But I'd say point to point, we're still looking at S&P up 4% for the month, NASDAQ up 5% for the month. I think, could the market continue to chop around and do some work? I think it probably will, for sure. I think the big dynamics in the game more broadly are still pretty favorable. Why do I say that? We think growth is fine. We think the U.S. grows, call it 3% this quarter, 3% this year. I think that's a good backdrop for risky assets. On the Fed, I know you had Jan Hatzius on recently.
Yeah.
We think they cut in September. Do they not? I don't know. I just know the Fed can avail themselves of 525 basis points should they need to. And then the view on mega cap tech is still, for me, just don't constrain your imagination around the supremacy of the biggest and the best companies on planet Earth. Is the technical setup demanding? It is. Is valuation demanding? It is. Do we have, again, a couple hot spots in the market this week we need to sort out? We do. So I guess what I'd say is I think the primary trend is still higher, but I think probably the gradient of the rally or the upside convexity of the rally will be flatter in the next phase of the game.
But if the technicals and the valuations of large cap tech are a little challenging, what does that mean from a performance standpoint, do you think, as the summer gets going?
Well, I think what I'll continue to do is separate U.S. mega cap tech, the Magnificent Seven, from the rest of the tech stack. And so I still look at the Magnificent Seven. I think to myself, convexity to the AI theme, buybacks, CapEx, a bit of dividends, and then that sustained superior earnings growth. On a given day in a given stock, of course there can be softness. I just think as a cohort, like I said, I don't want to constrain my imagination about what these companies can accomplish.
Keep your eye on the ball is how you've been telling your clients to think about these names.
100% correct.
Right?
Yes.
You called them, I think, earlier in this week, the sword and shield. The implication being that they give you offense when you need to play it and they protect you when you need a little bit of protection. That continues as well?
I think so. And again, there's going to be, at various turns, parts of that cohort that fall off the pace. I mean, Tesla's been down meaningfully all year. The Magnificent Seven as an index unto itself is still up 20%. And so I'm not...
Thank you, Nvidia.
Thank you, Nvidia. And, thank you. I mean, the majority of that stack is still up. Nvidia is the bright and shining example of this winter take more dynamic.
Yeah.
I still think we're going to live with that in the next phase of the game.
But what happens if the shiniest example of the mega cap rally starts to get a little tarnish to it? What happens?
It's going to be a tough putt. It is, I think, the most high profile stock on planet Earth since October of 2022, when everything made that low. A $280 billion market cap became $2.8 trillion. Why? Because earnings grew tenfold. So it earned that. I think it's now a question of kind of the law of large numbers and sustainability. Again, I'm not smart enough to know when to sell that stock. I hope I'm smart enough to basically stay out of the way of the upward momentum. And I think, you go into your Twitter feed and you find some of these, I think, kind of lazy analogs drawn to Cisco in the year 2000. And I think to myself, well, if you were too early to that trade in 98 or 99, that stock rallied 140 or 150% per year into the peak. So I'm just not willing to say now's the time to sell that stock.
Okay, I think the other question beyond, whether tech is too stretched or valuations have gotten too rich is the consumer, where you suggest that the consumer will, quote, defy the bears. What gives you that confidence?
With appreciation for how much pressure there is at the very low end of the income stack. If I take a bigger step back and I take a look at the U.S. consumer in totality, I'd say, again, U.S. is growing above trend, full employment. Wages are now outrunning the rest of the inflation basket, so real household disposable income's going up as the year goes along. And then I think it's kind of this Rick Reeder point about the balance sheet. So yes, $20 trillion of debt is a lot of debt. $156 trillion of household net worth is enormous. And so I think that the compounded effect of the wealth effect from the housing rally and from the stock market rally is now measured at $50 trillion in the COVID era. And so I think, again, there will be selective pressures for sure, but I think in totality, if we're right on the labor market and we're right in the economy, the consumer's going to be okay.
So you believe the story that, I'm glad you mentioned Rick Reeder, he made that case right here on this program. specifically as it relates to the baby boomers. The amount of money that they have amassed, whether it's been, growing their cash through either the stock market or money markets, or, for whatever, and now they have all of this investable income. You really buy into that story.
I think the point that he made very well is, for the first time in 30 years, households have more cash than they do debt. That's a change. That's not something even in our long careers we've seen. And so I think the longer you park your money wherever you do, and you effectively earn 5 3/8, that's an up arrow for consumption, not a down arrow in the context of interest costs.
Last question. So I said 10 days or so we get this Fed decision. We get to see the so-called dot plot. Give us an idea of when we may get, or how many cuts are expected. If it's more hawkish than the market expects, is that a problem? Are you thinking about that in your near-term forecast for the market?
So the Fed wrote down 3 in December.
Last time,
and they stuck through to the present day, as you say. The market's pricing less than 2, though. So I think if there was a modest adjustment, I don't think that's going to be a big surprise.
What if it's none
for the market?
What if it's none?
Yeah, I think that'd be some local turbulence for sure. Now, I would say this. I think the bar for them to raise rates is very high. The bar for them to delay cuts is very low. And so where I keep coming out is I think they're probably going to leave the car parked at 5 3/8 for a while longer. And I think we know from the past year, since last July, the U.S. economy and the U.S. stock market can do just fine at 5 3/8.
Okay. We will see what happens. Tony Pasquariello, thanks so much.
Thanks.